Stocktake is brought to you by Intelligent Investor, Australia's leading value investing research house. Get your free trial by heading to intelligentinvestor.com.au. The information in this podcast is current on the day of recording. It is general advice only, does not take your personal situation into account, and may not be suitable for you.
Good morning, everybody. My name's John Addis. I'm the founder of blah, 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 blah. I think you know by now. We have also with us today Gaurav, Sodhi, blah, 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 and Nick Cummings in the French version. Blah, 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 blah. Welcome, everybody, to our podcast. Today we have two topics. We are going to talk about the perplexing energy market and the even more perplexing semiconductor market. We're going to kick things off, though, with the energy markets. Gaurav, so as I understand it, the Strait of Hormuz produces somewhere between a fifth and a quarter of the world's oil, or doesn't produce a fifth and a quarter of the world's oil.
Do you know, John?
Through it.
John, my 8-year-old now knows that fact. He knows about the Strait of Hormuz.
It's child abuse, man. Child abuse.
Something's wrong with the world when our children know these things. These should not be known facts. Only nerds should know this.
Anyway, so we have before the crisis in Iran, I think oil was exchanging hands for about $60 US a barrel, and it is now around $100 US a barrel. So what's that, 35% say increase? Does that seem like the right kind of adjustment for the fact that a quarter of the world's oil supply is now no longer coming from its original source? Are we compensating for it elsewhere? Is that price increase underdone? Could we expect it to go higher? What's going on? Because it seems to be a mismatch.
Yes, you're right. There is some. I've been very confused by the energy market, because had you told me a year ago that the Strait of Hormuz would be closed, this has been a nightmare scenario that's been talked about, written about, planned for decades. And under those scenario planning, the ones that I've seen, it's the estimates say that when the Strait of Hormuz closes, oil prices were expected to get to $200 a barrel.
Wow.
And so we're sitting here at $100. In America, in North America, there is no change. Inflation's gone up a little bit, but there is certainly no supply constraints. Here in Australia, we've had prices go up a little bit. There's certainly no supply constraints. You talk to anyone out of Asia, and their world has changed. There are restrictions, closures, and rationing happening all over Asia, in big economies like India, in small economies like Vietnam, Cambodia, in relatively advanced economies like Malaysia and Thailand. Like it's happening across the board. So there has been this is a very important and impactful event, and we are not feeling the impacts of it here in Australia, and especially the Americans, I don't think would have any idea about how important and potentially damaging this is. And it's certainly not reflected in financial markets.
So why are we not feeling it too much, and they're feeling it a hell of a lot?
Yeah, because in a supply-constrained world, Australia has a lot of leverage. We are one of the largest energy exporters. So the countries that have large refineries also import a lot of our raw energy. And so the government's been pretty smart, and they've gone to those countries and said, look, if you want to keep having our coal and LNG, we probably need to keep getting these oil tankers in. And so we're actually pretty well placed, whereas we have leverage. Yep. So, I mean, that can only last for so long. I mean, the supply issue has also been helped by a rundown in American inventory. So you can actually track American inventory levels, and they have fallen dramatically. And it looks as though the Americans are running through their inventories to prop up supply that has been displaced from the Strait. And I was listening to an interview with Daniel Yergin, who's like the godfather of oil. If anyone is interested in the oil market, the only book you need to read is The Prize by Daniel Yergin, written in the 90s. And it is still the book on oil to understand the oil markets.
And I think if you understand the oil markets, you often understand geopolitics as well.
Yeah, that's a good point. He has become, actually, I think his role now is a geopolitical role at a university rather than an energy role, which kind of makes your point nicely, John. But there is anyone who knows something, anyone who has something to do with the physical oil markets is in panic mode, and they are strongly suggesting that there is real energy scarcity about to hit us, and the risk of energy scarcity is very high. And financial markets are just not saying that. So look, I just wanted to point out that that often with the way we like to invest in commodities is not to predict where prices are going to go. We don't want to buy on low PEs, nothing like that. What we want is optionality. The way we make money in commodities is by buying a commodity when one future has been priced as a certainty, because we know that commodity prices are variable. And at the moment, the certainty that is being priced in energy markets is that everything is going to be fine. The oil futures market is actually, the gap between the spot and the futures market is one of the largest it's ever been. The futures market is telling you that energy supply is going to be fine. And in 12 months' time, we're looking back at sort of $60, $70. And I don't think that's a realistic scenario at all. At minimum, because even if the Strait opened tomorrow, we've had infrastructure being damaged. So it will take years to repair. You've got shipping costs, insurance costs, which are going to be higher for a very long time. And you've got an Iran that now has now exercised leverage and knows it has it. And the risk of it exercising again is always going to be higher. So there's always going to be a higher security premium in oil prices. So I think the idea of getting below $100 is quite unlikely. And that's not what the market is telling you. So I guess what the reason we're talking about this is that energy prices and equity prices of energy stocks, we're talking Karoon, Woodside, Santos, Horizon. You can even extend that further into the coal stocks, which remarkably have actually fallen over the last little period. Incredible, yes. Thermal coal prices are up slightly, but equity prices are down. And I think the energy complex is quite hated and unloved. Everyone is trying to get out of energy because they think eventually this war is going to end and all the backlog of oil is going to be released. And anyone who knows something about the physical oil markets is telling us that is not a likely scenario. And you've got this really clear mismatch between what the physical market is telling us and what the financial markets are telling us. And I think this is the kind of asymmetry that we like to play with in commodities. And so, yes, I think there is an opportunity now in energy. And but if you're a subscriber, you'd know where we're looking and where we've recommended. And I think those are good places to be at the moment.
Nick, have you got any comments on that? Does it seem strange to you?
Yeah, it does. And it sort of reminds me a little bit of COVID. I know we discussed this on Monday in our morning meeting.
It's a great comparison.
But yeah, like you remember the first month of COVID when it was confined to China, then it was just in Iran, then it was a little bit of Italy, and then it was the whole world. And markets continued to rise for most of that period until they eventually started to fall. And I think the same thing, potentially could be happening here, where the S&P 500 is at all-time highs. The war was supposed to last 4 weeks, then 6 weeks. Now it's 10 weeks. And there hasn't been an impact, at least to Western economies yet, but that doesn't mean it's not going to happen. Eventually, reserves will be run down, and if the Strait doesn't open, which it doesn't seem that likely that it will anytime soon, that there's going to be huge problems. These problems aren't just confined to Vietnam and India. They might be for the moment, but if it extends, they won't be. And I guess the other thing too, which is a bit puzzling, is markets are hitting all-time highs while inflation has started to tick up again. And we've seen that first bout of inflation in sort of 22 come under control. But now around the world, and including Australia, inflation is getting a bit more sticky. And there's forecasts out there, even in the budget last night, for inflation to fall back to 2.5% next year.
That seems ridiculous.
Yeah, that seems very, very aggressive in their forecasting there. And the problem why inflation is such an issue is because it it's in contracts. Workers demand that they get real wage increases, and that's why it becomes sticky. And if we have a couple of months where inflation, or a couple of quarters where inflation is higher than what people thought, that's a real issue. So I do think the market's sleeping a little bit on this one.
I like the optionality here because if you run $100 oil, and I really think that's the base case scenario now. No one's running $100 oil through these equities. Everyone's got the futures market plugged in, which is telling you around $70. And when you run $100 oil, like the economics changes quite dramatically. We end up with big free cash flow yields. And if you can get a business that can allocate capital sensibly, you should be looking at quite big dividend yields out of a lot of these energy companies. I think I was running it through New Hope, and we're getting easy double-digit free cash flow yields, like well into the double digits. Karoon is getting double-digit free cash flow yields, and then they're spending on capex at the moment. Once that spending stops, you start getting really juicy numbers. And I don't think the market is looking at that at all. It's so focused, I guess, on the second topic, John. It's so focused on AI and chips that the energy stocks are getting really forgotten. I think that is this is a moment of opportunity in energy.
Can you, before we get onto that, can you just clarify one thing for me? When you talk about oil prices and then say how you would expect higher oil prices to push up coal prices as well, to what extent can coal ever be a substitute for oil?
No, coal and oil are not LNG and oil. So there's been a lot of impact on LNG production out of Qatar. Qatar is either one or two, depending on what figures you use. Largest LNG producer in the world. The largest LNG facility in the world just got hit, and the Qatar has been very quiet about what kind of damage is done. But these are multi-billion-dollar installations. Woodside spends $20 billion a piece on each of its projects. So we're talking huge installations, very expensive and demanding to repair. I think we're talking years if there's significant damage. So as LNG prices rise, LNG is a thermal fuel, and thermal coal, of course, is a sort of generation fuel as well. So those two compete. If Japan or Taiwan can't get the LNG to run its fleets, it will switch over to coal. And you're already seeing some of that. Okay. That's why the thermal coal prices moved with LNG prices.
I get it. So they do have that optionality then.
Yes, oil is very different. Although I will say that the rise of EVs is turning oil. There is a kind of a negative correlation now with oil and thermal coal as well, because a lot of EVs still run on thermal coal.
Yeah.
And as oil prices rise, there's a switch.
Obviously. There's
a switch over to EVs, but happening all around the world. Look anywhere, and EV sales are flying. Lithium consumption is flying, and that requires generation, typically coal.
Okay.
So this is all linked.
Is one to watch.
But the end destination is that energy prices seem to be very optimistically priced, and they're priced. The equities are priced as if energy is going to go back to normal. And what I'm saying is that there's a very good chance that energy is not going to go back to normal, and that optionality has created an opportunity.
Okay. All right. I think we'll leave it there and we'll move on to the next topic, which is, Nick, you have spoken regularly in our weekly meetings about semiconductors. None of us are expert in semiconductors. I think there are only about 20 or 30 people on the planet who are experts
who know how to do it, right?
Yeah. So, we're not alone in our ignorance, but we do have some interest in the sector, especially in respect to what happened in the dot-com bubble and what seems to be happening with AI and semiconductors now. It seems as though the AI bubble sort of moves from one subsector to another. Do you want to flesh that out for us and explain what's going on and why it's important?
Yeah, absolutely. So as you mentioned, I've been chatting about the semiconductor stocks for a couple of months now, and they've more recently just gone parabolic. So I guess with the chip stocks, it started with probably NVIDIA and GPUs, and that company now has a $4 to $5 trillion market cap. But more recently, it's moved to other chip stocks, so memory providers like Micron and SK Hynix and Samsung, as well as CPU providers like Intel. And the whole supply chain surrounding these companies has been caught up in this massive AI trade. And so you've got this dichotomy at the moment in the markets where you're either an AI beneficiary, and in particular chip stocking, you're doing fabulously well. Your share price is up like a lot. And then on the other hand, you've got value stocks and quality stocks and maybe even energy stocks trading at, in some cases, their lowest multiples ever despite earnings, continuing to grow. And so why this reminds me a little bit of the tech bubble the dot-com bubble is it was the same pattern of behavior where all investors were focusing on was dot-com businesses. And now the same thing's happening. All the focus is just on AI. If you're a company, that's growing your profits but not an AI beneficiary, your multiple has been crunched, and that's really interesting for us, as investors, because this sort of irrational behavior really creates great opportunities. And then coming back to semiconductors, I mean, just to throw some of the numbers at you, and I'll have to remember a few of them, but like Micron, for example, is about to produce $100 billion in net income next year based off analyst forecasts. Yeah. This time last year, its market cap was $100 billion. So it's
That's
insane.
Astonishing.
Its main competitor, SK Hynix, could do about $200 billion next year in operating profit. Wow. And they have this scheme where 10% of their operating profits go to an employee bonus pool. So each one of their 35,000 employees, on average, could get a bonus of $700,000 US next year if those numbers come to fruition. So it's just crazy, and that's probably the biggest.
Is it too late to go over there and get a job in the canteen?
No, well, it's not. I guess the numbers haven't hit yet, so I don't know how long you've got to work there to qualify for the bonus pool and all those sorts of things. But there are. The point here is that there just are real profits here. It's a bit different to the tech bubble in that regard. But then there's other segments like Intel, which is now, been a basket case of how not to run a chip business for a decade or more. It's now valued at the same market cap as Visa, and it's probably, I think, tripled over the last 6 months. And the profits haven't come through
been more
there
true.
Yeah.
To say that your job in life is to stay alive long enough to get lucky, and this is Intel all over. Like they've ballsed up every strategic decision, and here they find themselves. They're the new Twitter. What was the phrase that Zuckerberg had for it? It's a clown car that fell into a gold mine.
That's brilliant.
Well, that sums it up perfectly, and so that's what's sort of happening. And so there's companies that deserve to be up a lot because the earnings are going to rise. The question I have is how durable these earnings are, and this is where the similarities come back to the tech bubble. I mean, you've got myopic focus on one area of the market. You've got similarities like huge investments in the infrastructure layer based on really future orders and unknown demand patterns and unproven returns on investment. You've also got a circular investment thesis going on again. In the dot-com boom, it was the dot-com companies raised all these money and they would invest in each other, and that sort of kept everything going for a little while. And now you've got, Microsoft investing in OpenAI buying compute off Microsoft using capital expenditure to go and buy chips off Micron and NVIDIA, and then rolling out these data centers, and then NVIDIA going to invest in OpenAI. So there's that circular function as well. But it's worth pointing out there are real differences between these two booms as well. Probably the two biggest differences are funding and bottlenecks. And the funding difference here is in the dot-com boom, most of the funding was IPOs. Yes, a little bit venture capital, but mainly IPOs. Whereas we really haven't got a wave of AI IPOs yet. And the funding this time is actually coming from the profitable business models of the hyperscalers. So companies like Microsoft, Google, Amazon, if you look at the most aggressive estimates, they could spend about $1 trillion next year on capex, and that $1 trillion goes somewhere else to the Microns of the world and etc. But because that funding is funded by or is coming from advertising, e-commerce, software for Microsoft, the cash flows are much more stable. And so the funding can go on a lot longer than, say an IPO funding cycle, which can shut down overnight. And then I guess the other one is the bottlenecks. There are real physical constraints about rolling out these data centers and also increasing chip production. We're short pretty much everything. We're short electricians, we're short land, water, energy, chips, you name it, we're sort of short it. And that can just, stop the bubble from inflating as quickly as previous bubbles. So this could go on for a while. So it's important to point out the other side as well.
Can I ask a question about the chips? Because, we've all been investing for a long time, and chips has for a long time been known as a chronically cyclical business where you see these wild swings in profitability and capacity gains. Why have these SK Hynix and Micron? Why have they not increased capacity?
Well, I think they are trying to. They just can't increase capacity enough to keep up with demand. Like Amazon's spending $200 billion this year, and bringing a chip factory online takes many years. It's not overnight. You need planning permits, all the rest of it. And so, it's somewhat similar to energy in some regards. You can't, go into Venezuela and turn on oil production overnight. It's similar here. So the demand has just been unprecedented and far bigger than anyone thought. And so we're just going to be short supply for a number of years. The worry is, as you said, semiconductors have gone through these cycles throughout history. And what happens if in a year or two supply starts to come online, but demand isn't quite what they thought it was going to be, and the whole thing could reverse. And that is a real risk, that supply overshoots demand. But at the moment, we are just really, really short supply. I guess another risk is maybe a potential DeepSeek moment, again, where the models update, or there's a new model that is less compute intensive, so we don't need as much compute as we thought. I'm not smart enough to handicap those odds, but that's a risk as well.
So do we buy now, Nick? If this goes on for a while, can we pile in? It was Soros, right, who said, was it one of those legendary investors really changed my mind on bubbles. I used to think bubbles was something you avoid at all costs. Now I am open to piling in on bubbles, because there's so much. They last longer than you think, and there is so much money to be made in a bubble. Yeah, and I think you miss out by sitting on the sidelines with your sensible Buffett hat on. For some part of your money, participating is not a stupid idea. Well, it's a stupid idea, but it's not an unprofitable idea.
Yeah,
this is Gaurav's version of the if the music's playing, you've got to get up and dance.
Yep.
Pretty much. And I think it was Druckenmiller's quote, the crowd's right.
Okay.
Yeah, quite. The crowd's right 80% of the time, so you may as well follow them. So something along those lines. I'm paraphrasing, but
okay.
Yeah. Look, there's. For a company like Micron, if you looked at the fundamentals of this company and you think we're going to be short supply for a number of years and that AI demand is going to continue at the pace it is or even accelerate, then there is absolutely an argument to buy that business today. I think it trades on 8.5 times next year's earnings, so it's not expensive. But the whole thing is, if you get it wrong, the stock could collapse.
Yes, that's right. That's right.
So it's if you knew where we were in what inning we were in the investment phase, obviously you can make a bit more informed decision. But I just find it personally hard to do when a business has risen already so much. And I got this wrong with Nvidia, to be fair. I didn't think that those profits were sustainable as long as they have been, but they've proven to be. So maybe this is a case of that as well. But it's just everything is going up, and it's now that investors are also selling off these profitable, high quality businesses, value stocks as well, to rush in behind this wave, and that sort of worries me a bit. And I guess the other risk too here is the economics are unproven. Yes, a lot of people are adopting Claude and OpenAI and Google's products, but revenues really need to keep accelerating for a long time to justify the amount of money these hyperscalers are putting into capital expenditure at the moment. And just one quick example, I mean, in the headlines already, you've seen OpenAI, which has been losing share, in potential financial trouble, and other companies have been, or these hyperscalers have been investing behind it. They have $1 trillion worth of commitments for cloud computing and data centers outstanding.
Wow.
So and those commitments are used by Microsoft and Amazon to go and say, oh, well, we need this much to satisfy that demand. So we need these chips, we need these data centers. If that evaporates, then suddenly there's this big hole. And other people would argue that will be filled by better AI companies, et cetera, et cetera. So you can make that argument as well. But this is not a foregone conclusion. And the same as the .com boom wasn't. Like, in terms of Amazon, people investing in Amazon were right. It changed the world. The internet changed the world. It just didn't do it in the time frame that people expected. Which and this could be the second reincarnation of that, I guess.
Yeah. Just in defense of bubbles as well, I think there's been a change in the consensus on bubbles because of AI. I've read a lot of people saying that bubbles are actually a very important part of the capitalist process. You need bubbles because that's how you get these big build-outs of infrastructure. You need the availability. You need crazy optimists to provide the capital to build these big projects, which have happened throughout history. And this is the latest example. So even if it doesn't work, well, at least we'll be left with a lot of infrastructure. I think, Nick, going back to your example of the .com boom, everyone built out fiber optics in the .com boom, and there was supposed to be this big wave of demand, and there was billions of dollars spent, hundreds of billions of dollars spent, and all those telco companies made terrible returns on their investments. But we did have the basis for for data centers, for cloud computing, and for everything else that came because of all the fiber optics that was laid down in that time. And it could be similar now here. So we could end up with this great legacy infrastructure at the end of it.
I think there's a very high probability of that. And for anybody who has read, as I have, Carlota Perez's Technological Revolutions and Financial Capital, you'll see that this is
who hasn't? Who hasn't?
Who hasn't? Who hasn't? Who wouldn't want to read a British Venezuelan scholar who likes talking about Schumpeter and contrastive waves? No, it's absolutely compulsive reading, but it is useful to understanding the economic dynamic. The fact that you get this massive overinvestment and that has an economic payoff that is incalculably valuable, but blows up a whole heap of capital on the way
That's
there,
right. That's
and
right.
does a load of investors in.
Yes.
But it ends up being like the canals are still there, the railways are still there, the fiber optic cable that was laid during the .com bubble is still there. Google probably owns most of it now. And the same thing is likely to happen with this.
Yeah, 100%. And the CEOs of these companies recognize that, right? So the CEOs of Microsoft and Amazon are all saying that it's too risky not to invest, but we're a bit uncertain about it. So they're acknowledging those risks. The same with railroads, same with the telcos. It could happen again.
I find it difficult because with my resources hat on, I know that when a commodities business is deep into its capex cycle, that is not the time to pour money in. So I remember when all those LNG projects were being built in the mid 2000s in Queensland. If you invested in any of them, you just lost money, lost piles of money. And that's generally been true of capex heavy investments. And so, Amazon, Microsoft, these companies are pouring hundreds of billions of dollars in. I can recognize these are outstanding businesses, but I've still got that lesson in my head. And it's the reason I don't own Amazon yet, although I talk about it every single meeting, I know, Nick. But I haven't bought it yet.
Well, we might save that for another conversation.
Oh, yes. Okay.
Yeah. Nick and I are planning on doing a deep dive on Amazon. One of the things I find fascinating is that Amazon, in terms of AI, doesn't really have a dog in the fight. And I don't know whether that gives it a competitive advantage, but that's something that Nick and I can explore in our next deep dive. In the meantime, I'm calling an end to this podcast. It sounds a little bit like our weekly meeting. You get you've had an inside view of Intelligent Investor over the past 30 or 40 minutes. If you do want more of us, Nathan and I are recording a webinar tomorrow, which should be up on the website on Friday when this podcast comes out, which is on a once-in-a-decade opportunity. And it's actually, I know that is a ballsy title, but we feel as though there are some really good high-quality businesses that are trading at very attractive prices because all the attention is elsewhere. So if you want to look at that webinar, that will be up on the Intelligent Investor website. Please go and take a look.
And just a spoiler alert, it's not WiseTech or Zero, which I think
it's not Wise.
If everyone else is saying those are great buys, no, they're not.
No, they're not. Okay. Yeah. All right. We will be back in 2 weeks. Gaurav, thank you for your time. Nick, you too. And we'll be back in a fortnight.
Yeah, we're going to go back to waving our clenched fists at clouds.
Yeah.